September, policymakers tightening of fiscal policy, with the headline PMI swiftly losing ground after a modest rebound during July. The latest figures now point to weakest overall pace of manufacturing growth for almost 2 years. This is something the Fed will be looking at in terms of raising rates. At this mic, we feel that rates should not be raised. According to survey respondents, the strong dollar continues to put pressure on export sales and competitiveness, while the heightened global economic uncertainty appears to have dampened client spending both at home and abroad. Alongside this, manufacturing investment in goods, which cites growth headwinds from the slump in capital spending across the energy sector, sluggish manufacturing demand conditions, and subdued cost pressures remain in further restraint in terms of factory gate pricing during August. Output change inflation has broadly flatlined this summer and remains close to its lowest record in the survey the past 3 years. So much for the U.S. And I'll check on our time here, and we'll get to a little bit of the Fed minutes here. And we'll just do basically the highlights. This was the Fed Open Market Committee meeting, was held July 28th through 29th. Chair Yellen was there, and Dudley, the vice chair, etc. And some of the other officials of the Fed were also in attendance. And let's see. The open market counts reinvestment policy. This policy normalizes principles plus plans adopted at the September 16-17 meeting. The committee indicated that it expects to cease or commence phase out of reinvestment of principal on securities held by the SOMA after beginning increasing the target range for federal funds rate after it begins that, and the timing of this decision will depend on how the economy and financial conditions and economic outlook evolve. A staff briefing at the meeting provided background on attorney strategies the committee could employ with respect to reinvestment. These strategies include either characterizing and quantitatively or specifically enumerating the economic conditions under which reinvestment would cease or reestablish a time. Just a second here, and we will point it. Would cease in establishing a date and time interval following the initial firming of the federal funds rate for new policy on reinvestment to begin. The briefing also noted that the committee could phase out reinvestment gradually or in reinvestment altogether. In this decision, most participants expressed a preference that the timing of the cessation of reinvestment be based upon quantitative assessment of economic conditions. The outlook participants generally favored continuing reinvesting during the early stage of normalization, initially using only increases in the target range for the funds rate to reduce monetary policy accommodation. It is called quantitative easing. This approach, as viewed as consistent with the committee's plan to rely on changes in the target range for federal funds rate as a primary indicator of the stance on monetary policy. The participants thought that it might be best to either wind down reinvestment or to manage those reinvestments in a manner which would smooth the decline in the balance sheet in a predictable way. However, some participants supported ceasing reinvestment all at once at an appropriate time. Participants indicated a range of views there, using the same strategy for both agencies Treasury maturities was viewed as simpler to communicate, but a number of market-specific considerations might suggest employing different strategies for each asset class. No decision regarding it was made. And let's see here. Total non-farm payroll employment continued to expand solid pace in June. The employment rate declined to 5.3. We're just going to hit the high notes here. After declining 5 consecutive months, industrial production rose in June, partly reflecting an increase in outputs of mines. Real personal expenditures appear to have risen at a solid pace, that's from the Bureau of Economic Analysis. Activity in housing sector improved somewhat. New starts of single families declined in June. Won't go much into that. A survey of primary dealers. The DEX survey remains stable. However, market-based measurements of inflation compensation was still low. The 12 months ending in June, the normal average hourly wage for all employees increased just 2%. In Canada, indicators suggested that lower oil prices weighed in on investments in the energy sector. Energy production in April was curtailed by wildfires and maintenance shutdowns. Economic activity also weakened in some Latin American countries. By contrast, second quarter activity growth was strong in China and the UK. Staff reviews of financial situations. Financial conditions were affected by developments abroad for the intermeeting period, and was little changed on balance there. Over net 5 and 10-year treasuries yield a somewhat lower measurements of inflation compensation over the next 5 years. Treasury inflation protection securities declined. Equity prices were little changed. The foreign exchange value of the dollar rose modestly. And we'll hit a few of these highlights here. We kind of having to move participants considered a proposal by a subcommittee on communications for a few modest modifications, summary of economic projections that could provide further information to the public. And a lot of this is transparency at the Fed. A staff briefing reviewed proposal for publishing medium values of the projections starting time September meeting, noting that public commentary frequently focuses on the midpoint of the central tendency of the projections, and mediums would provide more robust summary measurement of distribution. Participant views. The subcommittee also proposed removal of the histograph depicting participants' preferred year liftoff there. We won't go much into that. These are technical things. The committee ratified the DEX domestic transactions over the interim period. The board meeting concluded at the end of the policy discussion. I jumped a little bit ahead of myself here. Potential enhancements to summary of economic projections. Next, consider that. A staff briefing reviewed. They're publishing we already did that one. Sorry about that. That's okay. Won't get into real private expenditures. We've covered this in the past in detail. We'll get to inflation. The staff forecast for inflation was revised down, particularly on in the near term, as a decline in crude oil prices over the intermeeting period was expected to resume in lower consumer energy prices. All the energy prices and non-oil import prices were expected to begin to rise next year. The committee's longer run objective of 2% in over 2016-2007 inflation was anticipated to move up gradually to 2%. and it possibly could go down. Inflation was, in the long run, objective to stay up view the uncertainty around a July projection for real GNP, a little bit behind there. Business views on current condition, economic outlook. In a discussion of the economic situation, the outlook meeting participants viewed the information received over the meeting period as suggesting that economic activity has expanded at a modest pace. We just talked about that. Investment remains soft as a drag from sharp contrast in drilling rigs there, and industry contacts point to gradual solid business conditions. We won't spend any time on that because we just did the market there. China could pose a risk to U.S. activities. Some participants cited downside risk to inflation, pointing to the absence of any noticeable response of inflation to reductions in resource stack over the past several years. The risk of further declines in oil and commodity prices, the oil prices have declined. Participants discussed a range of topics associated with the financial market developments and stability. And they do mention Puerto Rico in passing here. In their discussion of monetary policy for the period ahead, the members judged that information received since the FOMC meeting in June indicated economic activity has expanded modestly in recent months. A range of labor market indicators are balanced, suggested that underutilization of labor sources has diminished since the early in the year. In assessing whether economic conditions have improved significantly to initiate firming in the stance of monetary policy, committee noted on balance a range of labor market indicators suggested underutilization of labor resources, one of the dual mandates of the Fed. However, several were concerned that the labor market conditions consistent with maximum employment could take longer to achieve, noting the example, a lack of convincing signs of accelerated wages. In considering the committee's criteria in respect to inflation from the beginning, policy normalization, and most members viewed the income data as reinforcing their earlier assessment that although inflation continues to run below the committee's objective to downward pressure on inflation from the previous decrease there in energy prices and the effect on the dollar would abate. Well, everything that moves up there, we'll dispense with this and move on here. We'll start running a little bit late here, and let me check the time. I think we'll just go ahead and do the numbers at this point in time. We've presented a pretty rounded figure. Pretty rounded figure. Let me see if we can bring up the Bloomberg report quickly here. Stocks fall almost most in 4 years as China def sinks markets. This is from Bloomberg's. Let me get this oil pricing thing, then we'll go to the numbers. Falls below $40 a barrel for the first time since 2009. That was in the depression. Plunged to $40 a barrel in New York for the first time in 6 years, extending the longest decline since 1986 on concerns of slow demand growth there, prolonging a global glut. Prices tumbled almost 35% since this year's highest close in June, as producers pump away even after oversupply pushes price into a bear market. West Texas Intermediate crude dropped to $32 on persisting surplus, Citibank said. Meanwhile, China's economy will slowed increased expectation demand will wane. That was from Citigroup. It's also clear that major problems in Saudi, Russia, and the U.S. and others are major producers. I'm battling for market share. That is from John Kilduff, at again Capitol in New York.